Thursday for Momentum Builder and Sales Mastery to make sure that you have all the tools that you need to succeed in this crazy mortgage market that we're in. And as we do that, we're in an environment right now where nobody wants to touch their first mortgage, rightfully so, but they want to touch their equity. And so we want to make sure as originators, as branch managers and leaders in the space, that we have every possibility for people to access their equity in the best way possible. And, you know, you have your traditional HELOC where you're going to be battling with the banks and you're going to be battling with the credit unions that are giving teaser rates down in the sixes. And then there's this opportunity that we have, which is, I'm going to call it a digital HELOC, if that's okay, guys. Which is the instant HELOC or the fast solution or the easy solution to touching home equity. So sometimes speed is the most important thing. And when speed is the most important thing and simplicity is the most important thing, and nobody wants to go through the brain damage of a full doc loan, this is our HELOC solution. How you doing today, friends? This is Tim Rowen and Anthony Stratus, friends of mine from Finance of America. We spent many years together as side by side and succeeding together, and we're going to continue to do that.
Awesome. Well, thanks for having us. I know this is fun. Yeah.
Yep. So we look, Figure's been around for a while. It's not a new product, but it's new to a lot of people. And you could argue that it was something that was boutique-y and maybe not mainstream. And why would you take out a HELOC when, you know, when first rate mortgages were at 2.5% or 3%? You probably wouldn't. And so I think it's the right product at the right time for the right person. And today, I think this serves a lot of purposes, including one that is maybe a little not the ideal use case for you guys at Figure, but you guys tell me if I'm wrong. It's also potentially a bridge product.
Absolutely. There's
no comment.
There's use cases there, but it really purpose driven. But, you know, Gino, actually, before we dive in so much from a product perspective, and Anthony can actually speak to this much better than I can, but you mentioned Figure's been around for a while, and we have. Anthony's been here probably 1.5 years longer or so than I am. So you're what, Anthony, about 2.5, 3 years in?
2.5 years now, yeah.
Yeah. So I think it's important actually to understand the path that Figure has been on, and really kind of a testing ground, if you will. My perception is as Figure first started off, it's a DTC look and feel, right? It's that direct to consumer. Where's the need? Do we have the market? So on and so forth. And then Mr. Stratus comes along and starts adding from a partner perspective or different channels of our lending industry. And Anthony, I think you would agree, that's where things really started to ramp up and take off. For us, right?
Yeah, so look, you know, you're 100% right. So Figure did start off as DTC, and we did hundreds of millions in DTC, and we certainly learned a lot about how consumers go through the flow, how to improve conversion, how to deliver a delightful experience, a lot of things. And we will always have a DTC sandbox, as we like to call it, to be able to test things out. But that's not our growth engine. We are not interested in hiring a sales force. We are not even interested in being the biggest lender out there. What we're interested in doing is enabling our partners, be they brokers or IMBs or whatever it might be, to use our technology to originate these loans in their name. And then we sort of provide an end-to-end solution, including takeout. And that's the secret, right? HELOCs are fantastic in today's market, and we're seeing incredible demand. I mean, just to kind of put it in perspective for you, we're doing something like 400, 500 million a month. That is a lot of HELOCs, as you can imagine.
Yeah.
And, you know, the point is that that's great for us, and we're doing a lot of HELOC production, but for any one originator, it's still a small portion of what they do. And so the real secret sauce for us is that we deliver it in an end-to-end way that makes it as easy as possible for originators to do it, while still delivering that client experience and speed that we're known for. That's our strategy.
So I'll go back to the history of me as an originator and where the HELOC lied in my world. So for many years as an originator, when somebody called me and they wanted a HELOC, I would say, you know, we don't really do that. Why don't you go to Logix? Okay. Well, the problem with that is that eventually they become a Logix customer and they never come back to you, because now they start getting dripped on and marketed by Logix. And, you know, quite frankly, at the time, they always had good products, right? Those credit unions, remember, credit unions are, I'm going to tread lightly as I say this, but they're a quasi non profit organization, because their idea is to come out with a net zero, right? They're not really trying to make a profit. They're just trying to give their members the best benefit they possibly can. You caught that, huh, Don?
Yeah.
I'm
Don caught
hijacking
you.
his,
He's in Don's office today.
hijacking his office today. Yeah. And so we used to just give them out, but then we realized that there was a massive risk of the consumer not returning. So then the next thing we started doing, and this is back when we had TCF was our lending partner.
I remember
We
that.
rolled out TCF wholesale, and we were utilizing TCF wholesale, but we charged no origination fee. We did the whole thing for free, right? And so it was completely brain damage to do a free loan for someone, and it was a courtesy. But why? Because it was once every 2 months that somebody needed one, and that was okay. Fast forward, when we were the years at Finance of America, call it the last 10 years, God, the piggyback got really strong, right? And so we started using companies like Symmetry and Quorum and companies like that to fuel the piggyback market. Now, where we are today, so as we go through the transition of everything, is now it's the only thing people want is a HELOC.
Yeah.
So that's
You know,
kind of the history of HELOC as I see it as an originator.
Well, Gino, it's almost like you and I have spent a week together in the same room, because everything you just said is spot on. And Anthony has heard me say this time and time again. Loan originators, all of us as a whole, would react to a HELOC exactly how you said. You know what? Just call this person, or and it's important to me to understand why that's the case. You know, we labeled this segment why HELOCs and why now, right? Is how your team came up with that. And I would actually take it one step further and say, why haven't we done these in the past? And it's to everything you just laid out. You know, it's that 30 to 45 day escrow process. It's full appraisal, it's disclosures, it's closing costs and closing costs and closing costs, on and on and on, right? And what do? We just turn around and say, yeah, no, I don't really want to deal with that. And I tell folks all the time, that is actually what we've solved for. That's the process we've solved for. The product is what it is, and make no mistakes, it's a great product. But what we've actually solved for is that process right there, if that makes sense. You know what I mean?
Yeah, I mean, look, I think that speed is very important when it comes to HELOCs, and I think even why now, right? I think why now is something we could dig into for a little bit. It's because as a consumer myself that had gotten into financial trouble in 2007, 2008, it's no secret most of us did get into trouble. Why? Because they had no income.
There's that.
and so we're seeing today consumers that are starting to see a rise in costs of living, and they've been starting to finance their lives on their credit cards. Well, a HELOC compared to a credit card is still an amazing interest rate, you know, and if it's interest only, it's even better. And so it's a debt consolidation tool that we can utilize. And also people are in denial, Tim and Anthony. People don't think they have a problem until it's too late. So what they do is they call someone like me when they're like, hey, I don't know if I'm going to make my mortgage payment next month.
Right.
And you're like, what do you mean? That's 6 days from now. 8 days from now. Like, you didn't think to call me the last 3 months that you were struggling? Nope. Right.
Yeah.
Well, do you still have a job? Yeah. Okay. So you just spend too much. That's okay. Oh, you have too much credit card debt. Oh, maybe this car note is killing you. So even as when I said bridge product, it doesn't necessarily mean bridge lending to get out of a home and go to a new home. I describe a bridge as getting you from where you are to where you want to be next. Right.
Sure.
I like that. I like that.
So sometimes we could use this as a primary debt consolidation tool that we can get done very quickly. Doesn't matter what the rate is. Speed is the most important. Why? Because if I pay off revolving debt, it's going to jump my FICO.
It's
So
going to jump your FICO. It's going to lower you know, of course, Gino, and everyone on the call, I'm sure, gets it. It's going to lower your total monthly outgo for sure. You know, even though the HELOC rate may be higher than what someone might be think of a traditional HELOC, but it's still considerably lower than a credit card, car payment, whatever the case is. You know,
yeah, to be fair,
Yeah.
it's marginally higher. It's not outrageously higher. In the scenario that I just looked at a couple of days ago, is 2% higher, which sometimes speed is way outweighs that. And costs way outweigh.
Yeah.
So
Look, speed and experience. I'm like, you're looking at it from the consumer's perspective, right? There's also the LO's perspective and the amount of effort and time and energy you need to put into doing one of these loans. And it has to make sense for you too. And we've spent a lot of time making sure that it's an efficient process for the originator and the customer, not just
I see my buddy
the
John in the
customer.
chat there, and John brings
Yeah.
up there was no liquidity in the HELOC market or CES market. There was no CES for 10 years. I don't remember
Let me
seeing
tell you.
recently when they came back.
Let me tell you, a year and a half ago was not pretty for us either. This was pre-Tim. I was here for it. There was definitely some moments that perhaps, the conversations that were being had with me is like, hey, can we slow things down just a touch because, liquidity wasn't there. But today it's unbelievably strong. Unbelievable. We can't originate enough.
Well, that also speaks to the liquidity in this market. What that speaks to is it speaks to the confidence in the value of homes across the nation, right? When there's confidence in the equity markets, that's because there's confidence in the value of the intrinsic asset that we're securing ourselves against. And so when we're seeing people comfortable lending to 90% loan to value, if you think about it, 90% is actually almost 100% financing, right? Because the cost of sale in average across the country is somewhere between 6 and 8%. So you're really, when you're lending at 90, you're actually look at Don making fun of you're actually lending at, let's call it 98. There's maybe 2% left for a borrower to cash out if you're at 90. So when we're seeing that, that means that there's confidence that valuations across the nation are going to hold. And I know if you look at the negative media, you're going to see that in 21 states there's price reductions, and you're going to look at those things. Those are hyper local situations that are happening, like Miami condos, areas like Temecula where they lost all Airbnb licensing. Things like that are the ones that are bringing down value. We don't see a widespread value decline. So in your back office channels, give us a little insight what you guys think about valuations across the country.
Yeah. The interesting thing, Gino, on that is when you look at our production, I think you guys would be shocked at the average profile of one of our borrowers. What would be your guess our average CLTV is on one of our loans?
Well, now that you said that, I'm going to guess lower.
Yeah.
Now I'm
I
going to
think you'd be
guess.
surprised.
Now I'm going to guess 70.
Yeah, like about 65. Yeah, like it's actually surprisingly low. I think that a lot of folks are taking our product, right? The speed, the ease, all that, because they have an immediate need that's in front of them. You mentioned that consolidation, that's one of them. The other thing that we see a lot is home improvement. I can't tell you how many times we've seen somebody take a HELOC for an ADU or for an addition or remodel, whatever it might be. Pool guys on the phone, they need 80 grand by next week. And yeah, we sort of fit the bill.
Hey, so you cover your ears, Anthony, but you know when a great time would be to use a figure HELOC? When you don't want an appraisal.
True.
You know that phone call that you get as an originator, be like, I need to finish remodeling my house. Oh, okay. Well, what are you doing? Well, I have no kitchen right now and I ran out of money. I have a solution for you.
Yeah, that works because as you know, everything we do is on AVM with a few caveats in there. But yeah, Anthony nailed it. Number one use case is debt consolidation. Number two is home improvement. Of course, Gino, you and I are over here on the West Coast. Anthony is not, but the topic of ADUs for us is huge, massive. Right, Gino? It's massive. In fact, I actually love it because I think it's a great way for us as an industry to really tackle the topic of affordability. Even myself, I'd love to put another ADU out here for my kids to rent from me or whatever the case is. So, and I don't think that's going away anytime soon, the affordability topic.
No, and I mean, also like the ADUs are also a solution for aging parents, right? Where you want them, you want them close, but you don't really want to live with them. You might want to have dinner with them, but you don't really want to necessarily share every moment and be in the house and have them comment on how you're raising your kids and all those kinds of things. So that's another really great use case for, like people that haven't saved enough to have their own, to age in place at home and build an ADU. So quick money always solves a lot of problems. And so I think for us as originators, our job is always just to solve people's problems. Ask them what they need, ask them what they're trying to achieve, and then try to find the right product that works for them. So,
and then Gino, you touched on this too, right? But you are helping your client at the time when they most need you. when the time comes for a refi, you could be 100% certain they're going to come right back to you. And another little plug for Figure, right? We are not looking to buy clients from you so we can cross-sell them a whole bunch of other stuff. That's not our model. Matter of fact, if you look at our agreements, we explicitly permit you to do cash out refis to pay these off. So our strategy is really to be there to help you, to do another transaction, help your customer. And if anything, you are accelerating the point that they're going to be in the money for a cash out refi because you're raising their average coupon. They have a first lien at 3%, say, now they're taking a second at 8%. The blended rate all of a sudden becomes 4.5. Well, you're not that far from being able to do a cash out on a 4.5.
Yeah, I just see that John's asking about HELOCs in Texas. We just had an experience. They're like this. If you don't do a lot of it, one of the things is people will move into a house and you have a 12-month seasoning period before you could do a cash out in Texas.
Right.
You have a reduced LTV, and I would be ignorant. I don't know what the figure process is in Texas. So you're teaching me at the same time. Tell me a little bit about that.
We are in Texas. We only go up to 80% CLTV in Texas, owner occupied, and it would be a 90-day seasoning from
Okay.
time of ownership. So any title, and that's across the board for us. Any title change of ownership is 90-day seasoning. By the way, mostly from a perspective of everything we do is digital, one thing talking to another, right? And so the reason for our 90 days is we believe it's going to take that long before the county and everything shows that who's the owner,
Yeah. Until we get our blockchain technology in place, right? Once every piece of title gets blockchained, things will move faster. But definitely,
we're working on that too.
All right, I'm
Yeah.
assuming you are, right? Ultimately, as a technology company. What other use cases are we not thinking about as originators on this call? There's a few of us here, but nationwide, you've probably seen some really creative uses and gone, dang, I didn't think of that.
So that's cool. And I think this will really resonate with your audience here. There's 2 or 3 things that really tickled me. We had an LO. So in our system, right, when you have access to our system, each LO has a personalized link. Anybody that clicks on that link gets to an application that's branded in their company's name with the LO's picture and contact information there. And when a loan gets done, they get paid. So there was this LO that got smart, took his personalized link, created a QR code, and went and handed it out to every pool guy in his neighborhood and started getting dozens of HELOCs to install pools. I thought that was brilliant because the pool guy loved to hand out a business card with that QR code on it. Why wouldn't he? It just helps him get the deal for people that maybe didn't have the money. And it was great for the originator because, he figured out how to mine his referral network to actually get more deals in a pretty low effort way. So I thought that was really cool. The other thing that's kind of new, and we're starting to lean in with our partners, we came out with a first lien HELOC that is priced super aggressively, almost at agency levels. So our first lien HELOC is at below 50 LTV, is priced at 680, 685 right now, which is pretty good. That's not too far. And the idea is that, it's kind of hard to do a cash out refi for a 50K loan, right? But if you can actually do a first lien HELOC for a free and clear borrower that maybe has a need to pay off debt, like you mentioned, or add an ADU or whatever, it's a pretty elegant way to get them money at a fairly low cost without paying normal origination fees.
Yeah, I mean, look, I got a call. Here's another use case. I got a call from somebody I know just a couple of days ago, and they said, "Hey, do you do hard money?" I said, "Yeah, sure. What do you need?" And they're like, "I'm buying a business, and the SBA turned out to not give me enough for what I need. I need to get money out of my house right now." I'm like, "Well, I'm not going to do a hard money loan for you because your first is already at 70. There is no hard money for you, but I'll get you a HELOC." He's like, "Well, I need it quick." I was like, "Okay." So,
Yeah.
so you never know when people are going to need money fast. I love the idea of the first lien HELOC because that tells me too that we could utilize that, and of course that would be okay with investment property.
Absolutely.
Okay, that's usually where we see first lien HELOC. We see first lien HELOC on investment property. I have this property free and clear. My neighbor decided to sell. I want to buy it. I told him I'd buy it cash, and I don't have the cash lying around. I just need to tap my equity quickly. So there are a lot more use cases for first lien HELOC starting to come up. In fact, first lien HELOC was unavailable for a very long time. Nobody had it. So it's kind of
I mean, we do it, but we didn't give like good rates for it. Like the rates were the same, and we don't think that's fair, honestly. If you're in a first lien position for Yeah, like really. So
Yeah, so we've aggressively changed the pricing, but Gino and everyone on the call, I think it's really important to dive into this topic a little bit more. One, the first lien changes we've made have already taken off in a big way. We see a lot of our partners using this in a big way. But really, it's important to understand what it's also helping us as originators accomplish. You know, if you go to do a $75,000 loan, I mean, Gino, you tell me, it's a loser because in order to meet the compliance and the high cost rules and everything else of a traditional agency loan, you almost can't do the loan versus unless you give it away. Well, because of our product, we don't have to fit in that bucket. So you see what I mean? So now we have a path to do that loan without all the compliance concerns of high cost loans and so on and so forth. So I personally believe that's going to be a huge game changer for us.
Not to go down this rabbit hole, but do we have compliance anymore? The CFPB's gone. Yeah, look, the HELOC is not a trade product, right? So you have the speed, and you don't have to deal with the stupid Section 32 high cost stuff that drives us nuts. And on the closed end seconds, it's an absolute nightmare, by the way. We lose money on almost every closed end second we do. They really are favors. And you know, at the break even point where you're starting to maybe like you didn't lose money and you didn't get into a compliance issues, right around 100 grand, 85 to 100 grand.
Right.
Tishkoff wants 200 bips on HELOCs. Okay, you sell that rate, buddy.
Well,
viable.
I was going to say he's right there.
Viable, yeah, it's viable. Yeah. So let's think about what else. So we know how to use it. Now, I also want to address something that's just to be transparent. Some of us have had frustrations with Figure. They've tried it in the past. And I think, like anything, it's because we don't have the patience to learn something new. And this is
there's that, Gino.
Yeah.
I mean, come on. I traveled around the country trying to get loan officers to learn something new. You know how that goes, right?
That's it. And I say we because I include myself.
Me too. Yeah.
You know, and so what we want to do is we want to say, okay, oh, I heard this is the easiest thing since sliced bread, and then you go to do one, and you're like, it didn't work. I'm out. I'll never want to see this again. Hold on. So the first time you went to go jump a rope, you couldn't jump the rope. It takes practice. It takes reps, right? You got to practice. And then Tim, we had you on a call last week with our team telling us the secrets, the ways to dive in, the ways to make sure that it is, and best practices. So just in case some people on the call have Figure, but haven't had success, why don't you give us some of the best practices?
Yeah, no problem. So two things. Anthony mentioned the direct link, like a lot of our partners have, and that's a link that goes to the borrower. Maybe they access it through a QR code, whatever, and that's the borrower working through that from A to Z. In fact, the loan officer might get an email every now and again saying, hey, by the way, John Smith is in rescission. Okay, that's one path. The other path, which I really lean heavily on, is the lead portal or the inquiry tool. Where I love focusing on here is the day in the life of an LO. To your point earlier, Don, you would refer, or Gino, sorry, you would, I'm so used to Don's office, right?
Yeah.
We would refer these out as loan officers because we didn't want to deal with this, this, and this. And again, that's what we've solved for. But as a loan originator, when I run an inquiry, it's really important to understand that that is absolutely the place for you to start. Even if you don't get offers, you will now have a soft credit score and an AVM giving you an idea of value. So I say all the time, even if you don't have offers, it's actually okay. Why? Because it took you, the loan officer, 2 minutes to get to that point. Don't stress over it. Don't try and fit a traditional loan process into this one, because the minute we don't, detach from a traditional agency loan and try and make it fit into ours, it feels clunky. It can be frustrating. So you almost, I tell folks in training all the time, everything we know about what it takes to traditionally do a loan, set it aside. Forget it for just a brief moment, run the inquiry and see where that lands, making sure you've got all the data correct. But Gino, you've seen it. It's literally, you can do it in 2 minutes.
Yeah. And again, that's what I want to make sure that we approach it from a way of two things. I think it has to do with how you approach it with the consumer too. When you tell the consumer, say, look, this may or may not work, but if it does, it's going to be amazing. Let's try it first. And if it doesn't work, then we move on to the traditional process. But right. I think we just say that instead of what we're used to saying is we're used to saying, I'm certain this is going to work and let's start the process.
Right.
It's okay to say, hey, this only works 50% of the time, but if it does, it's going to be the most amazing thing you've ever done. So let's try it first. It's the same way that I tell people when we use our automated verification of employment. It's the same thing. I tell them in our quest for an Amazon-like experience for you, we want to test this new technology that we're rolling out at our company. If it works for you, it'd be the easiest loan you did. If not, no big deal. We do the same thing we've done for 20 years, but let's try it first.
Yeah.
That's perfect. That's perfect. That's exactly it. No, really, it is, because like we could sit here and tell you that we're the lender for everybody. We're not. There's no such thing, right? There's no lender that could do every loan. We are freaking amazing 75% of the time and frustrating 25% of the time. But at least in that 25% of the time, we're not going to be frustrating over a 6-week period where we're going to drag you through a lengthy process, ask for this document, that like you will be frustrated for 2 minutes, but at least to Tim's point, you'll get an AVM, you'll get a soft credit pull, see what the score looks like, and then you can go on to the next option.
As you were
It's
saying
that
all that,
amazing.
as you were saying all that, Anthony, I wanted to jump ahead and make sure that Don doesn't get to this in the chat first. My wife says that I'm frustrating more than 25% of the time.
Yeah.
And Sonia agrees. There it is.
Yeah. And I'm seeing comments. I think, like, just to address that heads on, where you're going to get frustrated is like any digital automated underwrite. So first of all, we have 0 underwriters, human underwriters.
Not at
Everything
one.
goes through,
Yeah.
it goes through the same 782 steps, and we assess whether we could do a loan, and that's it. Where it gets frustrating is where you know enough about a customer to know they're damn well qualified, and our system just can't assess their income. Maybe because they have 6 condos and an LLC, maybe because they have so much depreciation that their AGI on their tax form doesn't support it. I can go through every scenario. That's where it's frustrating. And we have no avenue to tell you, oh, we'll look at it. Let's try to work something out. But again, the story that we keep telling is at least we'll give you an answer within minutes rather than dragging it out. And then you could take them down another path. There's a lot of other good options.
So you just teed it up perfectly. Who is your ideal client?
Ideal client, W2, has equity in their home, which just about every US homeowner does today. That's about it, honestly. Those are the two things. Like the simpler the income structure, the better we'll tend to do.
Okay. And now, so we identified that the W2 borrower is the primary, but of course, you do loans for self-employed borrowers, but there's
all the time.
Yeah. So some pitfalls, and we talked a little bit about that in our personal team meeting, and I just want to bring that to light so that people don't get frustrated. You don't evaluate business bank statements. So for
Correct.
those people that run 1,000% of their life through their business bank statement, this is not going to work. Now, for somebody that pays themselves from their business to their personal account, whether it be in distributions or W2 or a combination of thereof, then you're in good shape, right?
That's correct. And by the way, Gino, that's such an important point you make, because when we talk to loan originators about this, and this is the same no matter what loan we're doing, right? It's questions, questions, questions. Really understand what the borrower is looking to accomplish and how you're going to help them accomplish it. Well, to your point, if I'm having this conversation with a homeowner and I find out they're self-employed, I need to take it a step further. Okay, let's talk about how you pay yourself, if at all. If it's Schedule C, well, maybe it's going to work, maybe it's not. If, however, they're a corporation, they W-2 themselves, to your point, they're on a payroll into their personal bank accounts, I would tell the borrower, absolutely be prepared to link to your personal bank accounts. The other option is, for self-employed, is to just advise the borrower to skip all other income methods and jump straight to connecting to tax transcripts. Not tax returns, because again, to Anthony's point, we don't have underwriters reviewing tax returns. It's all going to be digital connections and tax transcripts in the tax return topic.
I see something sexy in the chat box. Third liens?
Yes.
What kind of
We
LTV?
do third lien.
What kind of LTV
70.
am I looking at?
Yeah, 70.
Wow. That's sexy. I didn't know. Learn something new every day.
Yeah, actually, when you talk about learning something new every day, Gino, and I'm right there with you here at Figure, I will tell you that we're we're making expansions and adjustments so fast. If I'm being honest, it's hard to keep up. In fact, I just came off a call like where we're deciding how do we better keep up on the guides and new rollouts and new enhancements. And about a year and a half ago when I started here at Figure, by the way, it's Anthony's fault that I'm here. I think it's important to note
It
that
is.
that he's the one that brought me over here. So I don't know if he loves me or hates me. I haven't quite decided yet.
And you feel the same way. It's mutual.
um, but as we've evolved, it used to be the loan originator was pretty blind as to what was going on in a file. And I'm happy to report that that's not the case anymore. And now we have a dashboard. You can see the status of a file. The loan officer is now receiving email notifications as to the statuses as they change. Also, if a borrower uploaded a condition, let's say photo ID of copy of their ID. Well, if it didn't pass, now the loan originator is notified and they have the ability to upload the condition on behalf of the borrower. These are all enhancements that we continue to roll out. And so the voice of the loan originator has really become a big part of what we've been doing over the last year and a half. Would you agree with that, Anthony?
Yeah.
So it sounds like the transition from direct to consumer to B2B has been successful for the company. It is the road to growth. That it gives you an automatic sales force. That's why people get into wholesale in the first place, is it gives you a sales force across the nation. Look at that. Adrian, my buddy Adrian, non-owner approved in 5 minutes. Woohoo.
Wow.
Oh, borrower didn't take it. Damn.
Anyway, well,
that'll happen. But look,
yeah,
at least you offered something in minutes, right?
that's it. That's the story, right? It's
Waste
okay.
a lot of time. I had a client call me yesterday. Unfortunately, her place burned down. She was a tenant though, and so she calls and she says, and we've done like 20 loans for the family, and at least 2 loans personally for her. And she's like, I'm already in escrow. I've been pre-approved by 3 banks. I'm like already like, ugh. Okay, I've been pre-approved by 3 banks. I'm already in escrow. I'm calling you because my dad wants me to call you. I got 5.875 with a point. I'm like, I know what a correspondent rate sheet looks like. That's a correspondent rate sheet at 0 with no rebate. I'm like, how is that even possible? So look, what I did is I said, hey, that's an amazing rate. I hope you the best, but how many people did you talk to? She said, well, at least 6 or 8. I said, okay, great. And where was everybody else? Mid-6s. I go, so do you think the market might be mid-6s? Do you think this is an anomaly and it might be too good to be true? She goes, it is, but I really want it. I said, okay, then you know what? I'm not going to collect your documentation or your paperwork. This is an exercise in futility. I said, move forward with them. And if you run into a problem, I need 8 days to bail you out and close your deal. I will be your bailout if you need it. And so my point to telling you that story is sometimes what we need to learn to do is cut bait faster.
Oh boy.
Right. That's really, I mean, because if time is our most valuable asset, what the worst thing that could happen is you spend 5 days with that lady and then you lose it to that person. Right. Let's not do that. Let's get to the bottom of what they want. Can we help them? If we can't help them, get the hell out of the way.
Yeah, and by the way, Gino, it's such a great point. And by the way, I might say you've actually been singing that tune for quite a while. I've heard you say that numerous times in all the years we've known each other, and I think it's a great point. And that again is the other part of the beauty. In fact, Adrian said it in one of the comments. Yes, the borrower didn't accept it. It took him 2 minutes of his life to get to that point. There's the magic right there. Now let's go back to the direct link here for a second. Let's assume that the borrower started with that direct link and they don't get any offers. Let's just assume that's what happens. You know what you just did? You potentially just obtained a brand new client to your sphere of influence. I can't tell you how important that is. Right? You also have the ability to build your database. Then with clients you already have in your, historic pipeline, your sphere of influence, and you're using the inquiry tool, again, 2 minutes, you find out what's the next move. Are you going to take it to a different place? Can you come up with a different strategy for the borrower? All of that versus how you laid out the scenario from years ago, Gino, of just referring it out. Don't forget this is a great retention tool. Now, I know a lot of us in the industry have been saying for several years, oh, next year rates are coming down. Next year rates are coming down. Well, here we are and rates still haven't come down. So the popularity of the product still continues to be very, very strong. But that I can't say with all certainty that's going to happen, but think of the retention opportunity there if in fact you helped them right now with their cash needs. I think
Well, look,
that's
I've been in this business for over 20 years now. I can tell you every time I've gone through a cycle like this where we do a bunch of HELOCs, there are HELOC amortization resets. And when those things come, it's refi after refi after refi after refi. They cannot afford the amortized payment. They just can't.
Yeah. By the way, that's something that I think, and in fact, I'm happy to tell you it's coming probably, I don't, Anthony can throw something at me here, but I believe we're a month out on this. But to your point of existing HELOCs reamortizing, those interest only products that are coming to the end of their 10-year period, whatever the case is, we will have the ability to pay off existing liens, non-figure liens, in about a month. In the middle of March is what the build out's looking for.
So right now, if I have a current second, I cannot pay it off with a figure product.
Not today.
Not
you
today.
can take your cash if you qualify, but you'd be qualifying in a third lien position with us. And then if that was enough to then you took your money and paid off that second lien, yes, but it's coming.
Okay. I didn't know that. That's good to know. That's one of those points that could cause frustration, right?
Oh, sure.
So I think that's a good thing to understand. And then what John just asked is, let's put this at the top of your suggestion chart.
Got it.
A teaser,
Hand in hand.
teaser rate. Okay. It doesn't
Ooh.
have to be a 12-month teaser rate. Okay. That's where I think the misconception is. I think a 3 to 6 month teaser rate is still something of tremendous value, depending on what we're trying to achieve. And I'll tell you right now, I have a friend who's trying to decide if they're going to sell their house or not. But in the interim, he'd like to have $50,000 to $100,000 so he doesn't have to be in a hurry to make that decision. So, but he says, but God, I don't want to pay 10, 12% on that money. If I'm ultimately going to sell my house anyway, I feel like I'm wasting all this. I goes, well, look, if it's a short amount of time, that's not a lot of interest and all that. But in their head, it's a high interest rate. So if you could put that, if you don't have that today, if you could put that on the top of the list, even a 6.99 note for 3 months would make it super sexy. John, tell me if that's good enough. And I'm not saying lose money on the deal. I'm saying use it as a loss leader to get more.
Yeah, that's
I think we could consider that. I mean, we do run specials from time to time, right? And being 1 to 2 points below market rate for 6 months is not it's not a whole heck of a lot of economics, believe it or not. We might be able to do something like that.
Yeah, that's a very interesting feedback.
We want credit. This call wants credit when you roll it out.
We'll give you an exclusive.
There you go. That's what we did.
We'll test it out with you. How's that?
I'll be your pilot. No problem.
No vest for you.
Yeah,
no
vest.
vest
No vest for you, Troy. Okay, everybody, if you do 10-figure loans in the next 6 months, you get a vest.
Yeah.
Look at all these commitments we're making on your behalf.
I love it. Yeah.
It's all good.
It's a bunch of salespeople is what it is. What about units? 1 to 4 units. Okay. No problem.
We have some expansion here. I'm actually
1 to 2 units today, but Tim has been beating up our credit team for the better part of 2025, and hot off the presses, our credit committee just approved 1 to 4 units. So
yeah, and by the way, I might add, and I want to take some credit for this here, Anthony, but when I first started, again, about a year and a half ago, we were running into this. We couldn't do duplexes. And it said, sorry, we don't do multifamily. What are you talking about? It's a duplex, it's single family residence, 2 unit, right? Well, we got that done where if it was coded duplex, we could do it. And so for the, I don't know, latter half of 24, we launched it. And I looked at some of the numbers this morning, Anthony, just in duplexes alone, we've done over 20 million in volume.
No, I know.
So anyway, Anthony will send me a bonus check for that later, I'm sure.
Damn right. Look, honestly, maybe one of the best things about Figure is that, right? As we get on these forums and talk to your folks over here and to you, Gino, we take feedback seriously. We're here to help you out. If you have good ideas and we can make it economically work, yeah, absolutely, we'll do it. Why wouldn't we? We're all here to help customers out together, right? So
yeah, and then
and we'll respond. We're a small shop.
I'm going to bring up an old pain point. This is something from people that when they were at Homebridge, they had this. So this may have been solved. How are you guys doing with condos?
Oh, We're great with condos. And
Fine.
So tell us a
well,
story. Do you need a condo cert?
nope,
Okay.
no condo cert.
All right. So for everyone on this call, you are now walking away with a golden nugget. First lien HELOC, no condo cert. You just got yourself a non-warrantable HELOC in first position.
Yeah.
And then to Troy's question here about the unicorn, we've been considering that. It's not around the corner, but the whole idea is if you're taking money out to add an ADU, add a kitchen or whatever it is to a house, can we take the post reno value and come up with a loan on that? We haven't done it, but there's some companies out there that do it. I don't know if you've run into Renify. They're pretty spiffy with that kind of offering. We've been assessing whether we want to do something similar.
It's a very small niche, but it's a niche. Look, we're building ADUs like crazy out here, and that's not going to stop. But future value with ADU is a little tricky in some areas. So I get it if you guys don't want to get into that space. Like you said, also, you can't get into everything. You got to
We're trying.
be good at what you're good at.
Well, and Gino, and of course you heard me say it, I think to your team the other day, I'm going to lean heavily on the process, right? And I want to do what I can to help loan originators understand and adopt the process. Start here is the messaging, right? Set the right expectation, whether you have offers or you don't. The reason that's so important to me is right now, today, the result is going to be a HELOC product. However, that's not always going to be the case. Off into the future, we've got some big things coming out, right, Anthony? We're rolling out piggyback, both purchase and refi. We're rolling out DSCR. We're rolling, so there's some huge things coming down the pipeline that if we can get loan originators to understand the process and train that, then all of a sudden you'll see additional product offerings as a result, not just the HELOC, long term.
I mean, DSCR is kind of a no-brainer. You guys can calculate average rent so easily now with the data that's available that I could totally see how that's going to be. That's going to be really easy. I could see that.
Yeah, and it'll be fast, right? Because we can use our same capabilities to pull the data that we need quickly. So yeah.
What else should I be thinking about? So we talked about condos, we talked about units, we talked about non-owner, we talked about first lien, we talked about a bunch of stuff, debt consolidation, ease of process, ease of use. I know what to talk about. Oh, guys, but I'm not going to make any money doing this. I can't do any volume on this product. You told us some really amazing things on Tuesday. Share that, please.
Absolutely. So the opportunity is real. It is not uncommon for us to see partners that as a partner group doing upwards of 30+ million a month in funded volume a month. And then we have loan originators. One in particular comes to mind that did 100 million last year in HELOCs.
Got that? 100 million in HELOCs.
I mean, that's a staggering number, right?
You said, and even though that's the anomaly and that's the unicorn, you said there's quite a few people in the 30 to 60 range.
Oh, sure.
Yeah. So look, if you could add 30 million in volume in HELOCs to your portfolio this year, what a wonderful way to make an income.
Gino, I was at a conference last week and I was peeking my head in every now and again, listening to some of the different speakers and whatnot. I always get into that, much like at Momentum Builder, right? And one of the speakers said something very, well, it was Arjun, and Arjun well, and love hanging out with Arjun. And he said something very interesting. He's like, look, loan officers, it's okay if you think you're not going to do any particular thing, HELOCs, whatever, down payment assistance, whatever the case is. But at the same time, acknowledge that if you're not going to, someone else will. And I think it's so important for us to understand that. Make no mistake about it, the opportunity for HELOCs right now in our market continues to be really strong. And if you're not doing them, someone else will. That's the reality. I think we finished the year, Anthony can confirm this, but we finished the year roughly running around 1.5 billion a quarter as a company in this product. So the opportunity is real.
The answer for George is yes. PRMG has an in-house partnership with Figure. It is your Lightning hybrid product is what it's called. Yeah. It is a white labeled product called Lightning Hybrid. What else do we have on the plate? So, okay, look, lots of success, ways to make money, ways to build clients, way to solve problems. What did we not cover? Is there anything that I'm missing that we didn't cover? I feel like we knocked it out of the park and just crossed a bunch of T's and dotted a bunch of I's.
No, I think you've got the gist, right? Just forgetting figure for a moment, right? And just trying to bring value to you all about the HELOC space. It is incredibly powerful today. There's a ton of demand, a ton of volume. Customers are clearly asking for it. Like we've covered here, right? Figure is not the solution for everybody, but boy, if you start with us, you can definitely open up a dialogue and help a customer out and give them other options if need be. I don't want to socialize some of our competitors out there, but you all know there's other good companies that do HELOCs, right? You can
Yeah, there's
whatever.
look,
If it doesn't work with us, send it to Spring EQ. They're good guys, like they'll get some loans done that we can't for well-qualified borrowers, and that's okay.
but please set aside 60 days.
Yeah.
Yeah, well,
Hey, that's the truth, man. I'm just gonna call it what it is, right?
well, and again, just from an overall perspective in the power and the use cases of HELOC, and doesn't necessarily again have to just be with us type of thing, but if I bought my house 3 years ago and my interest rate 7.75%, and I now, Gino, can talk to you, my loan officer, and you can do me get a rate and term at, let's say, 6 or 6.5%, whatever the number might be. That's great. You can save that homeowner some money. I would encourage that all day long. However, it won't take care of the borrower's cash needs. And as far as I'm concerned, that is a major need still. To your point earlier, you said credit card debt, whatever the case is, right? Well, I did some comparisons, Gino, and when you look at the cash out loan level price adjustments, one, you can only stop at 80, right? So that is what it is. It's crazy when the LLPAs, right, on cash
especially
out.
if you have a slightly imperfect FICO, and by that I mean 719.
Right. And what's interesting is if you do that rate and term and the borrower has the cash needs and you add a HELOC behind it. So again, almost like a piggyback refi scenario. Do you know the loan level price adjustment, regardless of regardless of CLTV with the agencies, is 0.625? That's the loan level price adjustment when adding a CLTV.
So let's talk about that, because one of the things that I always used to do for people as a courtesy is a post-closing HELOC. So is this a really wonderful tool to offer all of your clients to say, hey, you're putting 30% down, you're putting 40% down because you're rolling the equity from your old home because you want your payment to be in a certain place, but don't you want access to that capital? So can I do a post-closing HELOC for you as a courtesy so that it's sitting there? So two things. One is, do you pay on the draw or do you pay on the line? And then, so that's an important thing when you're working with HELOCs, because everybody's different as it relates to that.
Right.
And then the other is, is the post-closing solution something that's a healthy piece of business for you? Because the line might just sit there for a little bit.
So we have 90-day seasoning, right? Which kind of they'd have to wait a little bit.
It's not bad.
The other thing is, I saw a question about minimum draw.
Yeah.
So our product is very unique. We are fully drawn. Let me take a step back. In a normal situation, a customer comes to you and says, I need 50K. Can you give me the options? And then you go and give them the options. With us, it's a little different. We take the subject property address, stated income, and a soft credit pull from a customer, and we tell you we are willing to lend up to 300,000. Then the customer picks how much of that they want. If they get approved for 300, they could say, I only need 150. That becomes the line, and at closing, it's fully drawn for 150. And as it pays down, you can redraw up to 150.
But if I had a $300,000 available line and I didn't mind drawing on it and covering the interest for, say, for a month, and then paying it back down to 150, now I gave myself cap space. I gave myself a little headroom, right?
So look, I don't want, we have a few EPOs, right? But it's pretty liberal. It's 90% or more paid down. So in my example,
no. Again, I was talking about 50% or so.
Right.
Exactly.
Right.
So in my example, absolutely, they could take the 300 and they can pay back 150 next day if they wanted.
Okay.
No problem.
Candace says they pay the fee on the whole 300.
That's the thing. We have origination fees too. So, that is what you're seeing reflected in our pricing there, is that this is a purpose-driven product. Philosophically, we want the customers to take our HELOC to have a reason for wanting to take it. Be it home improvement, be it debt consolidation, whatever it might be.
One last idea, and then we'll start to wrap this up. First lien HELOC. Interest only?
No.
No.
We don't have interest only. I know.
Come
That's come up.
Come on, first lien HELOC interest only gives you the availability to get into the interest only space because you guys don't have any QM requirements. Come on, guys.
We might do that.
I was going to say it has
put it on
come
the
We
up.
might do that.
Yeah. Well,
And then
especially if it's first lien HELOC and you're talking about if you could deliver a first lien HELOC at the same price that I'm delivering a Fannie loan, then I can have a conversation about why somebody should take an interest only first instead of taking a Fannie and Freddie loan. You guys want me on the product development team?
it's a good question. Answering a couple questions. So I saw one from Candace on the 5% fee. That's the highest origination fee. We also have, 3 and 4%. Equally, we're going down the path of capping the origination fees at a specific dollar amount for higher size loans. So there's no good reason to charge 5% for a 400,000 loan. That's excessive. So we hear you. We're looking at that. We're likely to cap it in one way, shape, or form. Another question here about 5 investment properties, setting up a figure HELOC on all 5. We do have caps on individual borrowers, regardless on how many properties. We don't have caps on a husband, wife, cousin, and brother doing it though. So if there's different parties that own the home, then you can definitely play around with that a little bit.
And by the way, let's just talk about that real quick.
Is it how many, or is it total loan amount exposure? Is it
total loan amount exposure? So if I had 4 properties and I could lend 400,000, I could only do 100 on each. It's going to be that
200 on one and whatever the breakdown is. But it's a $400,000 limited exposure. I think that's plenty. If you could get it to 5, that would be nice, but
that has come up as well.
Just because that would get you in line with everybody else. Right now, that's a little bit, like if I'm looking at 2 products and one's 500 and one's 400, the slight disadvantage. But other than that, I don't think you need more than 5 in the HELOC space.
There was also a question if we will do these on properties listed for sale, and the answer is yes, we will. And just so you know what's happening, and when you're running the inquiry tool, there's a drop down. Is property listed for sale? Yes or no? If you indicate yes, even if the property's not listed for sale, let me say it like that. You check yes. What you're really doing is saying this loan's going to pay off within that first 16 weeks EPO period. The comp comes way down, but there's no EPO.
Wonderful.
All right, so you get something instead of nothing.
I think we did more than scratch the surface. I think we got to the bottom of it. For those of you that don't work with Figure today, definitely put your leadership group in contact with one of these 2 gentlemen. Sonia, if you could pop up one of their info, or Tim, if you want to throw it into the chat, and that way they can start.
I'll send some stuff over to Sonia as well, because I think she'll send out follow-up with 100%. Attendees like you guys normally do. And by the way, I'm excited, but I just have to share, Gino, also bummed because normally I'd be getting ready for Momentum Builder right about now, and you're making us wait until October.
Making you wait till October, but it is going to be absolutely amazing.
There's some feedback for you. You should do 2 events a year.
Well, I mean, look, guys, just so you know, on the roadmap, since we're all talking about the roadmap, on the roadmap, Momentum Builder will have multiple events throughout the year, and Sales Mastery is the flagship event. But a lot of different things that we're working on for the long-term vision of the company. And look, the acquisition of Sales Mastery was obviously a tremendous thing to have to put together, and it took us a few years. And to be partnered with Todd Duncan in the way that we are is an amazing blessing. Working with him, Don is on the phone with him 3-4 times a week. It's amazing. It truly is super. The Todd Father we named.
Yeah, I love that.
It took him a minute to embrace it, but we like it. He likes it now.
Well, you already know this, Gino and team, but we are anxious to be there again. And I think Anthony's first Momentum Builder was last year, I think. And I've been going since the beginning, and it's just what I know I'm doing every year. And then you well, you didn't postpone it. It's just a different date, right? It's like, man.
Yeah, but I will say that look, we moved it to Dallas to make sure that we could reach more of the country. Right. And you'll see the QR code down there. We're about to start announcing speakers in the next couple of weeks, but I promise you it won't get any cheaper than it is now. That's always for every event. It's that way. We need to start funding things now so we can start paying speakers and doing all that kind of stuff. So we always give our best deals up front, and our best deals are right now. But we're excited about it. We have some great speakers that are going to be there. We've changed the formatting. I don't know if I'm supposed to say this, but why not? There's going to be a new element that we've never done before called short shots. And for those that were there last year, We kind of experimented with it and got
Yeah.
great reviews. Those were, I think, 10 to 12 minutes. We're going to try to give, just to get as many perspectives as possible out there. There's going to be some 4, 5, 6 minute little segments, just so you get little nuggets from a bunch of different people.
Those are the Craig Davis Bacon bits last year, right?
Bacon bits. There you
That's
go.
right. Yeah, it's
that's right.
fantastic.
That was from the pre-show. And look at Don putting you guys on the spot. We're sending you the sponsorship options right now.
Send it over. Yeah, we are raring to go.
Damn right. All right. Well, thank you so much for having us. And we
awesome,
are going to
everybody.
sponsor Don. Yes.
All right, guys. Thank you so much. Super, super happy. Look at our next two guests. This is exciting. Cindy Ertman, what a friend of the industries and a friend